30 years ago, I was a stockbroker's dream client. Every morning I'd wake up, check my portfolio, and call my broker, panicked about the latest market dip. I was a slave to the news cycle, a chaser of the next hot stock tip. I thought that was how you built wealth, by outsmarting the market. I bought and sold year after year, and for all my effort, my portfolio barely grew. My rich clients, the ones who seemed to have everything, they were different. They never called, they never worried. They were building empires while I was just playing a game. I spent years trying to figure out their secret until I realized it wasn't about what they bought, but how they bought it. This is the story of how I stopped trying to trade my way to wealth and started investing like the truly rich.
Hello and welcome back. My name is Your Name, and today we're pulling back the curtain on how the wealthiest people in the world build and maintain their fortunes. We're not talking about day trading or meme stocks. We're talking about a long-term strategic approach that has been the foundation of wealth for generations. The first major difference, from public to private. The average investor is almost exclusively focused on the public markets, stocks and bonds you can buy on the NYSE or NASDAQ. But the rich? They have a significant, often dominant portion of their portfolio in private investments. These include private equity, venture capital, and direct investments in businesses. Why? Because the real growth, the massive returns, often happen before a company ever goes public. By getting in early, they're not just buying a piece of a company, they're becoming a partner in its growth story. Private equity, buying and building businesses. Think of a private equity firm. They don't buy 100 shares of a company. They buy the entire company or a controlling stake in it. They then work to improve its operations, expand its market, and increase its value over several years before selling it for a massive profit. This isn't a passive investment, it's active business ownership. They get to make the decisions, shape the future of the company, and reap the full rewards of their success. Venture capital, funding the future. This is where the excitement and the biggest risks are. Venture capital is about funding startups, the next Google, the next Tesla. The wealthy invest in these high-potential, high-risk ventures, knowing that most will fail. But the one or two that succeed, they will generate returns that can make up for all the losses and then some. This is a game of patience and vision, not a game of trying to time the market. Direct investments, the personal touch. Sometimes a wealthy individual sees a business they love and invests their own capital directly. This could be a friend's startup, a local business they believe in, or a new technology they've discovered. This allows for even more control and a more personal connection to the investment. It's not just about the money, it's about being a part of something they genuinely believe in. The power of tangible assets. Beyond private businesses, the rich also put a significant amount of their money into tangible assets. We're talking about real estate, art, collectibles, and even land. These aren't just investments, they're physical things that hold value outside the whims of the stock market. Real estate, in particular, offers a powerful combination of cash flow, appreciation, and significant tax advantages. They're not buying a single-family home to live in. They're buying apartment complexes, commercial buildings, and development projects. The role of a family office. For the ultra-wealthy, managing these complex investments isn't a side gig. They often have what's called a family office. This is a dedicated team of professionals, accountants, lawyers, and investment managers, whose sole job is to manage the family's finances. This level of expertise and oversight is something most of us don't have access to, and it's a critical component of how they protect and grow their wealth. Why don't we hear about this more? The reason you don't hear about this on the nightly news is simple. It's not news. The public markets are a daily drama with stocks going up and down. Private investments, on the other hand, are a slow, deliberate, and quiet process. They don't have daily stock tickers. The returns are measured in years, not hours. The takeaway. So what can we learn from this? You don't need $1 billion to start thinking like the rich. The core principles are accessible to everyone. Shift your focus from trading to owning. Instead of chasing the next hot stock, look for businesses you can own a piece of for the long term. This could be through a well-diversified index fund or by investing in a business you're passionate about. Think beyond the public market. Even if you can't get into private equity, you can invest in a rental property or even a small side business. Look for ways to own an asset that produces cash flow. Use diversification as a shield, not a lottery ticket. The rich diversify across asset classes: stocks, bonds, real estate, and private businesses. They don't just put all their eggs in one basket. The secret isn't a magic formula or a special stock tip. It's a mindset shift. It's moving from the perspective of a speculator to the perspective of an owner. Start thinking like the person who is buying the whole company, not just a handful of its shares. That's how you begin your journey to truly investing like the rich.